Sometimes the biggest story isn't the one making headlines. It's the pattern you only notice after looking at all of them. Three recent AI stories would seem to be about different parts of finance. One was about major technology companies borrowing enormous amounts of money to build AI infrastructure. One was about Nvidia using its balance sheet to support OpenAI's data center expansion. And one was about creating futures contracts for the price of AI compute. Taken together, they may be showing us something larger. Welcome back to Synthetic Politics. The AI economy is no longer just attracting capital. Specialized financial tools are beginning to form around it. Start with the bond market. Major technology companies are selling enormous amounts of bonds to finance data centers, power systems, networking, and other AI infrastructure. As demand for capital grows, investors compare opportunities and become more selective about where their money goes and what return they require. Capital flows towards some projects and away from others. Then consider Nvidia. OpenAI wants enormous amounts of computing infrastructure. But someone has to finance the data center buildings, land, power connections, cooling systems, and other physical assets surrounding the GPUs. Nvidia has agreed to provide contingent residual value guarantees capped at roughly $105 billion for the initial commitment. The exposure is conditional, phased, and limited to defined circumstances. Why accept it? Because a customer's financing problem can become a supplier's sales problem. If the data center cannot be financed, fewer Nvidia chips get deployed. Nvidia can use its strong balance sheet to absorb a defined portion of risk, helping make the infrastructure easier to finance. The risk doesn't disappear. It moves. And Nvidia gains additional financial exposure to the same AI ecosystem already driving demand for its products, raising questions about correlated risk and what some observers call circular financing. Then we get to compute futures. CME Group plans to launch futures contracts tied to rental prices for Nvidia H100 and B200 GPUs. If they develop enough trading activity, companies could hedge future compute costs by transferring some price risk to someone willing to take the other side. Again, uncertainty hasn't vanished. A new futures market is being built that could help determine who carries that price risk. New contracts can struggle to attract trading, and a benchmark won't perfectly match every company's actual compute costs. There's another wrinkle. CME Group is itself an investor in Silicon Data, whose GPU price benchmarks the contracts we'll use. That doesn't tell us the benchmark is unreliable, but the relationship is worth knowing as the market develops. Financial institutions are built by participants with incentives of their own. These mechanisms are different. Bond markets allocate capital. Guarantees redistribute credit and residual value risk. Futures contracts transfer price risk. But all three respond to the same underlying change. AI has become important enough that finance is developing specialized tools to support it. History has seen versions of this before. As electric utilities expanded, internal company funds were no longer enough to finance large power plants and distribution networks. Utilities increasingly turned to bond markets for outside capital. When automobiles became a mass market industry, General Motors created GMAC because customer financing had become part of selling cars. And as 19th century Chicago grain markets became more organized and standardized, futures contracts developed to help farmers, grain merchants, and processors manage price uncertainty. Different technologies created different financial problems. Finance adapted. That's the larger principle. When an industry becomes large enough, complicated enough, and important enough, the financial system doesn't simply stand outside it and provide money. It develops specialized financial tools around the industry's specific needs. New financing structures appear, price benchmarks emerge, guarantees divide risk differently. Futures markets allow uncertainty to be priced and traded. Finance begins helping organize the industry itself. Those tools can remove constraints and enable investment. They can also concentrate financial exposure and connect the fortunes of companies more tightly. The first phase of the AI investment boom was easy to see. Companies raised money and built computer chips, data centers, and power infrastructure. Now a second layer is forming around those physical assets. Investors are deciding where capital goes. Suppliers are helping finance customer infrastructure. Futures markets are trying to price future compute. Financial innovation cannot turn a bad project into a productive one. And moving risk does not eliminate losses. It determines who bears them. So as the AI economy grows, don't just watch how much money is invested. Watch the financial machinery forming around it. Who supplies the capital? Who absorbs the downside? Which risks can be traded? And what prices emerge when markets evaluate the future of compute? The AI economy isn't just building more infrastructure. It's beginning to build the financial machinery required to support an infrastructure economy. And history suggests that machinery can help an industry scale while creating risks of its own. Do you think these new financing tools make the AI build-out more resilient? Or are they creating deeper financial exposure if expectations eventually disappoint? Let us know what you think below. If this breakdown was useful, hit like and subscribe to Synthetic Politics. We'll be back when there's more to report.